Today, we will talk about advanced real estate investment tactics. More businesses than investments, these strategies can generate income and replace your job. But you must be prepared to invest the upfront time and effort of a business startup in order to make them work. 1. House hacking. House hacking is a strategy where an investor lives in one of the multiple units of their property and rents out the others. This could be in a duplex, triplex, or even a larger multi-unit building. By doing so, the investor can offset their own living expenses with the rental income. For many, it's an entry point into real estate investment, providing first-hand experience in property management while reducing personal housing costs. Over time, house hacking can enable investors to build equity in their property, benefit from potential appreciation, and transition to more extensive real estate investments. 2. BRRR strategy: buy, rehab, rent, refinance, repeat. BRRR is a comprehensive real estate investment approach. An investor begins by buying a property, often below market value, that requires some level of improvement. Next, they rehab or renovate the property to increase its value. Once the updates are complete, the property is then rented out to tenants, providing a steady income stream. After establishing a rental history, the property can be refinanced to extract equity, which can then be used to reinvest. This process is then repeated with other properties, allowing the investor to grow their portfolio, leveraging the equity from previous investments. 3. Syndication and real estate funds. Real estate syndication is a method where multiple investors pool resources to invest in properties and projects bigger than they could afford individually. A lead investor or sponsor identifies the opportunity, manages the project, and invites others to invest capital. Returns are then distributed based on agreed-upon terms. Real estate funds, on the other hand, are collective investment schemes, similar to mutual funds, where capital is pooled to invest in a diversified portfolio of properties. Both methods offer individuals a way to participate in larger, often more lucrative real estate deals with shared risks and returns. 4. 1031 exchange, tax-deferred exchange. Named after Section 1031 of the U.S. Internal Revenue Code, this strategy allows an investor to defer paying capital gains taxes on an investment property when it's sold, as long as another like-kind property is purchased with the profit gained by the sale of the first property. This tactic enables investors to roll over the gains from one property to another, allowing for continued property appreciation and deferment of tax liability. Utilized wisely, the 1031 exchange can significantly enhance portfolio growth by freeing up more capital for investment without immediate tax implications. 5. Wholesaling properties. Wholesaling in real estate involves entering into a contract with a property seller and then assigning that contract to an end buyer for a higher price, profiting from the difference. The wholesaler doesn't buy the property. They essentially serve as a middleman, connecting sellers with buyers without holding onto the property. This strategy requires a keen understanding of property values and a strong network of potential buyers. Wholesaling can be an entry point into real estate investment, as it typically requires less capital upfront and allows for quicker returns compared to traditional investing methods. 6. Real estate crowdfunding. This modern investment approach leverages online platforms to pool money from multiple investors for real estate ventures. These could range from residential properties to large commercial projects. Crowdfunding offers investors an opportunity to participate in real estate deals with smaller capital outlays than traditional methods. Platforms handle the due diligence and management, offering a more hands-off investment experience. It democratizes real estate investing, allowing individuals to diversify their portfolios with properties or projects they might not have access to otherwise. Returns vary based on the project and structure, ranging from rental income shares to profit participation upon sale. 7. Private money lending. Instead of investing directly in property, some choose to become private money lenders, offering loans to real estate investors. These loans typically have shorter terms and higher interest rates than traditional bank loans. The real estate itself usually serves as collateral, providing a level of security to the lender. This approach allows lenders to earn consistent returns in the form of interest payments. Private money lending is attractive for those who want to benefit from real estate investment without managing properties directly, and for borrowers, it can offer quicker and more flexible financing options than traditional institutions. 8. Tax line and tax deed investing. When property owners fail to pay their taxes, municipalities might place a line on the property or sell its deed. Investors can purchase these tax liens or deeds. With tax liens, investors essentially pay the owed taxes and in return, receive the right to collect those taxes plus interest from the property owner. If the owner fails to repay within a specified period, the lien holder can foreclose on the property. With tax deed sales, investors acquire the property outright. Both methods can offer significant returns, but they also come with risks and require thorough research. 9. Vacation rental arbitrage. This strategy involves renting properties on a long-term basis and then subleasing them as short-term vacation rentals on platforms like Airbnb or Vrbo. The difference between the long-term lease payment and the short-term rental income becomes the profit. It's an approach that allows individuals to generate rental income without owning properties. Successful arbitrage requires a keen understanding of the short-term rental market, including pricing strategies, occupancy rates, and guest expectations. Choosing the right location, offering unique guest experiences, and managing operations efficiently are crucial components of this investment tactic. 10. Commercial real estate leveraging. Leveraging in commercial real estate refers to the practice of using borrowed funds to finance a portion of the property purchase, thus amplifying potential returns. For example, an investor might put down 20% of the property's price using their own funds and borrow the remaining 80%. If the property appreciates or yields significant rental income, returns on the investor's initial equity can be magnified. However, leveraging also increases risk, as investors are obligated to meet loan commitments. Successful leveraging in commercial real estate requires careful analysis, understanding of the market, and prudent financial management. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.